Good morning, good afternoon, good evening. You're listening to Outsized Returns. I'm your host, Samuel Austin Taylor, Sir Sam T on all the social media channels. And so today, this is our 10th episode. And what I wanted to do, because on this podcast, we discuss a number of topics: real estate, investing, startups, entrepreneurship, how you can get from where you are present day, make it a better future, how your business can grow, etc. And if I were to classify any expertise that I think that I do have, or people would say that I may have, it would be around the investment arena and investing in the public markets, investing, planning for retirement, picking different mutual funds, portfolios, stocks, which asset managers, etc. Anything kind of in that realm, like I may be considered a go-to guy. Feel confident in saying that. And in some capacity, over the last 10 years, in one way or another, I've had clients and helped clients, at trillion-dollar organizations, honestly, at a number of trillion-dollar organizations. And so what I wanted to do today was put together a presentation that really discusses how what worked in 2010 and in the past is not what's going to be successful going forward. And even, we're in 2020 recording this episode, in August. What's going to happen going forward these next 10 years is not what's going to work from 2030 to 2040. So being able to adapt and being able to change and kind of be present in the moment, and also being a little bit more agile and knowing where the puck is kind of going, so to speak, is really important in terms of your investment portfolios. And so the title of this presentation today is Negative Noise Messing with Your Portfolio, ? For those listening. Here's what you can do now. And I read a lot of different material, books. One thing that COVID has allowed me to do is organize and arrange a number of different newsletter subscriptions into one email box. And so on a Sunday afternoon, for 4 or 5 hours, I may, read, I'm not kidding you, 20 to 30, different blog posts and things of that nature. And so some of the best things that I've kind of agreed with from some organizations that you're definitely familiar with, and then also some things that I've seen that are really important, I think that makes sense, I've included in this presentation. And so why don't we just get started? So here we'll discuss how some things never change, some recent trends in the mutual fund and ETF marketplace, and then also some investment solutions for today's clients. So some things never change. What we need to recognize is that the media has two drivers: get your attention, so increasing attention, and ad revenue. They know that if a dominant headline pops up, if they can flash charts and put them in your face over and over and over and over and over again, you're more likely to click on a button, go to this link, may even, actually go through a paywall to see some important information or something that you deem important. So that's why some of these headlines are the way that they are. U.S. unemployment is worse since the Depression, with a long line, down on a long line on the downside. Brokerage insurance firms raise concern about DOL advice proposal. Stock market's wild 2020 ride. It doesn't matter the geopolitical risk or the regulatory risk that's changing. It doesn't matter what's happening on Capitol Hill. They want to increase attention. So you have to recognize that about the media. We need the freedom of the press. Social media is very important. All those things considered, that's the media's job: increase attention, gain ad revenue. And so when market volatility happens, that is really heightened. This is a chart that really showcases we should anticipate volatility happening every single year. So for the listeners, this chart goes back from July 2010 to March 2020. And what you'll see is, one big pullback every single year over the last decade. And so what we have to recognize is that while volatility spikes rapidly and on an annual basis, and it's not something that you really can prepare for, this is something that we definitely need to anticipate. Doesn't matter if it's 2020 or 2025, we know that it's going to happen. So not overreacting to some of these events is really important because they're going to happen. Now, on average, the S&P 500 over the last 20 years is giving you about 6% return. But the S&P 500 has been around a lot longer than that. And so if you go from 1937 to 2019, you've averaged about a 10% return in the S&P 500. So what we need to recognize is that when you're investing, it doesn't matter if Facebook's doing well or if Amazon, is dominating the headlines because they're growing rapidly. If you're trading or if you're long just those stocks as an owner, totally fine. You have to be recognizing the volatility in those short-term events and how over the long period of time, they'll rebound. I mean, these are good established companies. We know that volatility spikes and it's, unannounced. How can I stay the course and kind of ignore those things, or maybe even buy the dip, but not sell too low and buy too high? A lot of people might not know this or recognize this, but the average investor, and an average investor here means somebody that's not a financial services professional. The average return for a retail investor is about 2%. And that tends to be pretty stagnant. I'll tell you that, in a number of presentations that I've seen, the average investor tends to underperform the market, and they don't have a financial advisor or anybody kind of guiding them, but it's really just an overreaction to some of these volatile events, essentially. So when you start to go even further out, you can notice that some of these headlines, again, are kind of bombarding the screen just to get your attention. And again, like I say, increase ad revenue. Doesn't matter if the tech bubble burst or there's terrorism or there's a banking crisis. The market, Warren Buffett has a quote where he says, I would not bet against the US, right? Like if you buy good quality US companies and hold them for the long term, you'll tend to outperform the market. And that's true. And what we need to recognize is that markets do rebound. So you can see from the chart, and I'll post all of these slides, maybe in a blog post on outsizereturns.com. But you can go to our YouTube page, youtube.com/outsizereturns, and also www.sirsamt.com. What this chart really does for me is showcases that, it doesn't matter where the market kind of ends or bottoms out. We have to recognize that if the market is down 20%, it could go lower, but typically the markets rebound. You can see, this chart goes back from about 1980 to 2020, and you can see that for the most part over any 4 or 5 year period, the market is significantly rebound. So it doesn't, like being out of the market, hurts you more than being in the market. But what I used to tell clients is that statement risk is of the utmost importance. Can you look at your portfolio? Can you look at your 401k? Can you look at your retirement accounts and see half of your portfolio gone like that overnight? You had $100,000. Can you see it being at $50,000 tomorrow and not panic? Again, that happens often. And we've talked about, the average investor's return is about 2%, while the S&P over the last 20 years is about 6%. That's the reason why. If I go from 100,000 to 50,000, I typically don't sell. If I got more money coming in, I'm trying to, buy things on sale. buy the Facebook, the Amazon, the Googles, the Rokus, etc., while they're getting beat up in the market. Because I'm still thinking about holding these companies for the next 10 years. And so what we in the industry refer to this risk is really statement risk. So every 3 months when you go see your financial advisor, seeing your accounts being down like that in that framework, it's not anything to kind of be blown away back by. So we talked about the media and their intentions, good or bad. This is really what they're trying to do, and how markets have transcended, from 1937 till now. Let's talk about some of the mutual funds and ETFs in the marketplace. So what you'll see is that, liquidity based on this chart is essentially cash. So think when the market is down, think, April 2020, COVID happens, shelter in place, is enforced, markets are down, unemployment is at an all-time high, highest since the Great Depression. A lot of people literally sell out of all of their assets and go to cash. That's like the worst thing that anybody could do at that period of time. Again, the Dow is at 25,000 and it goes to 19,000. I'm just throwing out numbers there. Selling at that period of time is bad. What you'll see here is that equities, stock investments, in the US and across the world significantly decreased. You see the same thing in taxable fixed income. So think, IBM or Intel, any of those companies that have bonds, and also, muni bonds referenced by tax-free bonds also decreased. A lot of clients decreased all of those investments as well too, and just put all their money in cash vehicles, money markets, things of that nature. What's really interesting is that while all of that happened, people also did not participate in the S&P 500's rapid increase, from like 2016 till now. And what I wanted to do with this presentation is really articulate how investor psychology is so important. Having the ability and the stomach and kind of the brass sometimes to just say, you know what, I'm not going to panic, I'm not going to overreact. It's something that I wanted to address on this podcast because it's really important. If you're willing to risk all of your money on one investment, you can't expect that outsized returns, no pun intended. You can't expect that outsized returns to happen in 12 months. You can, and it may happen, but if you're looking at things in that light, in terms of a best case scenario, you have to also plan for the worst case scenario. And if you're not comfortable with that, then, you should probably just buy the market and just, be easy peasy. Having a designated return is really important in terms of achieving financial goals. The best investors have the stomach or the patience to kind of, weather the storm, so to speak. And that has always worked in America. Buy and hold for 30 years, for the most part, has typically worked. I don't think that there is any 30-year period where, and I'd have to look this up, where the market was down over the last 30 years. And you think like somebody's, working life is about 30 years. On average, if you invest for 30 years and plan for 30 years, I don't think there's any time that you can lose money. Matter of fact, there's not a time that you would lose money. I would say that, the lowest, so the worst period of time, and I'm just pulling a number out of my head right now. I bet that number is probably somewhere around 6 to 7% still. So what we have to do is caution ourselves about that. But again, being diversified, because like I said earlier, what's worked in the past is not what's going to work in the future. And if I had to point to the most important slide of this presentation, I would think that it's this one. And so what we have here for everybody listening is two charts, one that has inflation and one that has nominal inflation. Basically, nominal inflation is, the actual price. Real inflation takes into account the increase of pricing out of the equation. So if you go back from 1989 to 2019 last year, in order to get a 7.5% return in the market, you had to put 75% of your life savings in cash and another 25% in US fixed income. What a lot of people don't talk about is that though that return is nice, you would take about a 3% risk, and that risk is measured based on what we call standard deviation, but let's just call that risk, about a 3% risk. Fast forward to 2019, in order to do that on a nominal level, you have to have large cap stocks. So think, Facebook, Amazon, Netflix, Google, these companies that, everybody uses for the most part. Small cap stocks, company that you've never really heard of. Non-US equities, so some company in France, or in Europe somewhere like Nestle. US fixed income, real estate, all of these different types of investments to get the same type of return. But your risk has increased 6 times. So last year to get a 7.5% return, your risk is now 18%. In 1989, to get a 7.5% return, your risk was 3%. And we recognize this, for a number of reasons. Your mom or dad or your aunt and uncle may remember getting a mortgage and the mortgage was 14%. That's not the case right now. I'm refinancing a house currently, just got approved for about 3.25% or something like that. So things do change. So, you can own real estate, but depends on the rate that you acquire the property and a number of those things. We also remember gasoline being, I'm old enough to remember gasoline being 99 cents, right? It's not the case right now. I live in California. I'm lucky to get under $4 even with COVID. So I drive a lot. I don't even look at the gasoline. I just pay because, if I save 5 cents from one way or another, I'm going to pay for it at some point in time. So the difference is it's minuscule. It doesn't matter to me. Nevertheless, we recognize these risks and these changes, and we know that all of these things change and we're all affected by these things. So if you only own big name companies and maybe no real estate, or maybe zero Bitcoin, or maybe zero gold, etc., that may be something that you would have wanted to revisit in 2030 today, right? So we have to talk about, not only our goals, how we put these things together, how they work with one another, and that's really important. A lot of people ask me saying, what should I be doing? And I may give stock advice about some things that I'm investing in, whether it's a REIT or a California tax-free mutual fund, etc. The number one response I have when people ask me, hey, where should I be putting my money? Is I'm always like, it depends. You got to tell me more money. I have to understand what you're trying to do with this money. A lot of people are also like, I need to make some more money. I need to go up. I'm trying to. It's not a casino. Some people may think that it's a casino, but it's not. And there are ways to be successful in the market. Having a long-term vision, being patient are two of the most important things, and really not buying extremely high and not selling extremely low are two really important things as well too. But in addition to that, owning the right assets, Warren Buffett is behind me, and he'll tell you that he would rather pay more for a valuable business than significantly less, for a company that is not as valuable. So, paying a fair price for Apple would have boded well for you over the last 20 years, right? When it was overpriced and people were saying that, the PE ratio is super high, et cetera. Buying, that's a good business. So the point I'm making is that owning different assets in different time periods may make sense. And you have to continue to revisit these things because industries change. Now, the next slide is some recommendations that I agree with. And I read Vanguard, I read BlackRock, I read Invesco. I've worked at some of these companies. I know some of the managers at these companies. I have my own insight as well too. Things that I would tell my mother and be comfortable with telling my mother about, and be comfortable putting my family's life savings into. I agree with. So here are a few recommendations that, if you look at some of these big name companies' capital market assumptions over the next 5 to 10 years, that I agree with. And so 3 investment solutions that you can kind of take advantage of. Let me move this. I'm recording this in Zoom. I love Zoom, right? That's a stock that I'm kind of bullish on. A lot of people aren't. Anyway, but active fixed income, volatility reducing assets through international securities, and also high dividend payers. So let me touch on active fixed income. You can see a lot of people on Twitter, on Instagram, posting their stock returns and like, yeah, man, I made $5,000. I made this much money. And you know what's funny is that there are 0 people that talk about, I don't know, I'm being a little facetious, right? And it's always been this case. I think stocks are a little bit more sexier. They're fun to talk about at dinner parties. There's a lot of hubris associated with them. A lot of people do not talk about fixed income securities. If you ask a random person to name 5 bonds that were just issued, I would bet that it would be impossible, to go find 20 people on the street right now and find those people and find somebody that would be able to touch on those things. So I think active fixed income is a perfect place to pay people that are smarter than you, to give them their money, you give them your money, and they invest it for you so you can get a paycheck every single month. One of my favorite fixed income securities is the Nuveen, I think it's called the Nuveen California Tax-Free Bond Fund. It's 5-star rated by Morningstar. I live in California, been living here almost 4 years. It's a fantastic fund. That's a good one to kind of own. In terms of reducing volatility, we remember we touched on, from 2010 to 2020, we've seen volatility shoot up rapidly, at least once every single year. Basically what that means is, and I'll go back to that slide just to reference it. We're talking about the flash crash, BP. That was so long ago. The U.S. downgrade for Europe and some other stress test assets. The Euro double dip, the taper tantrum. The taper tantrum was when Ben Bernanke, the Federal Reserve Chairman, talked about buying a lot of bonds. The oil recession in 2016, rising rates. There have been a number of things that have caused the market's short-term volatility, but it's been rapid. We're talking like the market going down over, a 3-6 month period, 20+%. And that's important to kind of, take in terms of your planning. But if you don't overreact, and if you have money to kind of take advantage of really that sale, it'd be a good time to do so. So owning international positions is something that I agree with as well, to kind of reduce some of that volatility. What's happening in the United States, not all the time, is not going to affect what's happening in Australia or in Europe or in Asia. in some of those developed countries as well. And then last but not least, high dividend payers. It doesn't matter if it's an ETF um, or a mutual fund. A lot of people, one of the easiest ways to create wealth is to just buy dividends. I'll give you a funny story. I was talking to my mom the other day. My mom worked at AT&T for 30 years, and she was saying, man, the stock has been at like $30 a share, since she retired. My mom retired about 10, 12 years ago, something like that. But she worked there for a long time. And there's some positions called Dividend Aristocrats. Dividend Aristocrats are companies that have continuously increased their dividend, the amount of money that they pay you on a quarterly basis. Some companies have yearly dividends, but most of them pay quarterly. They've increased their dividend every single year for the last 25 years. In addition to that, there's some companies called Dividend Kings. I think Coke is one of them that have increased their dividend consecutively for the last 50 years. I think Coke is a dividend king. I'm not sure about AT&T. I know AT&T is a dividend aristocrat. One of my favorite income or dividend type positions is realty income. I've been real big on REITs lately. And the reason I've been big on them is because, they've been beaten up because of COVID. In addition to that, they're paying out monthly income. And if you're like me, you kind of want to get out of the house and experience, a restaurant or something. They own the real estate associated with those investments. And they're required to spit out 90% of their income on a yearly basis. And so some of these positions are super important for a lot of clients. And so I think that hopefully this presentation allowed everyone to kind of figure out where we are now, what worked in the past, last 5-10 years, and give you a better idea of what's going to work in the future. Because again, even with COVID, from March to August, markets have definitely rebounded. You could almost pretend that August 25th is the same date as, essentially March, call it 15th. We're not that far off from that date. So just erase the last 5 months. What does that look like going forward the next 10 years? Because what's happened these last 5 months has transcended a number of different businesses. You can't do business the same way that you did in 2019, not for every single business, but for a number of different businesses, you can't behave and do things the same as you did in 2019. So what does that look like for these companies going forward? It may make sense to have an educated conversation or ask some questions to somebody else. If you have questions for me, I'd be happy to answer them. I may go live on Instagram here shortly, but leave a comment on our YouTube page. Also, you can tag me at Sir Sam T on Twitter, Instagram, Facebook, all those places as well too. And subscribe to the podcast. www.outsizereturns.com is the link. I'm going to drop this presentation. I'm talking to Brendan Mulligan. You may have seen him on episode 4 or 5, I believe. But he's working on some ways that we can do some of these things with the podcast. And I want to be able to, in timely environments, I want to be able to do something like this and send it to all of my subscribers. In addition to blogging and some of those other things. So if I have a webinar, if I have a guest, you can go onto the website and download it, or maybe we have a ConvertKit integration. He's working on a number of cool things right now. So stay tuned for that. But yeah, please go to www.outsizereturns.com. You can subscribe there. You can donate to the podcast as well through Anchor. Same place, www.outsizereturns.com/donate. And follow us on Instagram and on Twitter. On Twitter, our @ symbol is OutReturn. Trying to figure out a way I can get that outsize returns as sign account. And On Instagram, we're at Outsized Returns. I'm Sir Sam T, at Sir Sam T on all the social media channels. Thank you guys for listening to this episode. You know, being an extrovert and talking to myself, I talk to my wife, she kind of rubs me, she kind of razzes me a little bit about this all the time because I talk to myself a lot. But I wanted this podcast to be a great platform to have other guests on. So this one is a little weird for me, even though I've talked and kind of done a presentation like this for a number of different organizations over the years. And so thank you guys for listening. Subscribe. Let me know what questions you guys have, and stay tuned for next week's episode. Take care.